Two people make $1 million. Person A pays $370,000 in taxes. Person B pays zero, not a penny. Both are completely legal. One just knows the rules, the other doesn't. Let's talk about how that's possible. Picture this. You're scrolling through Forbes looking at billionaires. Jeff Bezos, Elon Musk, Warren Buffett. Their net worth keeps climbing, billions and billions. But here's the weird part. Some years, they pay less in taxes than a teacher making $60,000. Not because they're cheating, because they're playing a completely different game. The game has rules. Most of us don't know them because nobody teaches them. We learn how to get a job, earn a paycheck, pay taxes on that paycheck. That's the employee game. But there's another game happening simultaneously. Different rules, different outcomes. And the people who know those rules build wealth that never gets touched by taxes. Let me be clear up front. I'm not a financial advisor or lawyer. This is educational content about how the system actually works. You should always consult professionals before making financial decisions, but you deserve to understand the game board before you make your moves. So let's break down exactly how this works. The fundamental secret is this. The tax code isn't written to tax wealth, it's written to tax income. And here's the thing. Wealthy people don't have income the way you think of income. They have assets, and assets play by completely different rules. That distinction, that's where everything changes. Think about your paycheck. You work, you get paid, the government takes their cut before the money hits your account. You never see that money. It's gone. You get what's left over. That's the W-2 employee world. You're taxed immediately, automatically, unavoidably. There's no strategy, no optimization. You just pay. Now imagine a different scenario. You own a business. That business is worth $10 million. On paper, you're worth $10 million, but you don't take that as income. You leave it in the business. You borrow against it instead. The bank gives you $1 million loan using your business as collateral. Here's the key. Loans aren't income. Loans aren't taxed. You just got $1 million tax-free. Sounds too good to be true, right? But it's completely legal. It's called buy, borrow, die, the three-word strategy that explains how billionaires live lavish lifestyles while paying minimal taxes. They buy assets that grow in value, they borrow against those assets to fund their lives, they die, and through estate planning, their heirs inherit everything with minimal tax consequences. Let me make this concrete. Say you bought a building 20 years ago for $1 million. Today, it's worth $10 million. You have $9 million in gains. If you sold it, you'd pay capital gains tax, maybe $2 million gone. So you don't sell. Instead, you go to a bank and say, lend me $4 million against this building. The bank agrees. You get $4 million cash, no taxes. But wait, don't you have to pay back that loan? Yes. With what money? Here's where it gets brilliant. You take that $4 million and buy another building. That building generates rental income. You use that rental income to pay the loan. But rental income gets special deductions, mortgage interest, depreciation, repairs. Your taxable income from that rental is barely anything, maybe even a loss on paper. So let me recap what just happened. You turned $9 million in gains into $4 million in spending money without paying a single dollar in taxes. Your rental income pays your loan but shows minimal profit because of deductions. You're living off millions while your tax return shows you're basically broke, and it's all perfectly legal. Now let's talk about the strategies within the strategy. First up, depreciation. This is huge. Let's say you buy a rental property for $1 million. The IRS lets you pretend that building is slowly losing value, even though it's actually going up in value. They let you deduct about $36,000 a year as a loss, even though you didn't lose anything. So your building makes $50,000 in rent, but you get to subtract $36,000 in depreciation, plus $15,000 in mortgage interest, plus $5,000 in expenses. On paper, you made $50,000 but spent $56,000. That's a $6,000 loss. The IRS says you lost money. You pay zero taxes. But in reality, you pocketed thousands and your building went up in value. Magic. Here's another one.
the 1031 exchange, named after Section 1031 of the tax code. Here's how it works. You sell your $1 million building that's now worth $3 million. Normally, you'd pay capital gains on that $2 million profit. But if you immediately buy another property worth $3 million or more, you pay zero taxes. You just rolled your gains into a bigger property. People do this their whole lives. They start with one property, sell it, roll it into 2 properties, sell those, roll into 4 properties. Each time the wealth grows, the taxes stay at zero. Then they die, and here's the kicker. Their kids inherit everything at the current market value. All those decades of gains forgiven, erased, tax-free forever. That's called the stepped-up basis, and it's one of the most powerful wealth transfer tools in existence. Let me paint the picture. Dad bought stock for $10,000 50 years ago. Today, it's worth $10 million. If Dad sells, he pays taxes on $9,990,000 in gains. But if Dad dies and Junior inherits it, Junior's starting point, his basis, becomes $10 million. Junior can sell immediately and pay zero taxes. The ultra-wealthy take this further with something called a dynasty trust. You put assets in a trust that lasts for generations, in some states forever. Your great-great-grandchildren benefit from wealth you created, and because it's in a trust structured correctly, it avoids estate taxes. The wealth compounds for 100 years, untaxed, untouched. Now let's talk about business owners. If you're a W-2 employee, you get zero business deductions. You drive to work, can't deduct it. Buy a laptop, can't deduct it. Your coffee? Nope. But if you own a business, the rules flip completely. Suddenly, everything becomes potentially deductible if it's for business purposes. You need a car? Buy it through your business. That's a deduction. You travel for business? Flights, hotels, meals, deductions. You work from home? Deduct your home office. You meet clients at restaurants? Deduct the meals. You need to stay informed for your business? Deduct subscriptions, courses, conferences. The list is massive. But here's what most people miss. It's not about cheating. It's about structure. The IRS doesn't care if you pay less taxes. They care if you follow the rules. The rules favor business owners because policymakers want to encourage business ownership, investment, and job creation. So they wrote the code to reward those activities. Take oil and gas investments. The government wants domestic energy production, so they created insane tax incentives. If you invest in an oil well, you can deduct up to 100% of your investment in year 1 through something called intangible drilling costs. Invest $100,000, deduct $100,000 immediately. Your taxable income drops by $100,000. Or conservation easements. You own land worth $1 million. You promise never to develop part of it. You'll keep it as forest or farmland. The IRS lets you claim that as a charitable deduction, sometimes worth 3 to 5 times your actual investment. Your $1 million easement creates a $4 million deduction. Your taxes disappear for years. Opportunity zones are another big one. After the 2017 tax law, they designated certain low-income areas as opportunity zones. Invest your capital gains there, and you get to defer taxes for years. Keep the investment for 10 years, and the new gains are completely tax-free. The government is literally saying, invest here, pay nothing. Now let's talk about something called a Roth conversion ladder. Most people think retirement accounts are locked until you're 69 and a half. Not true. Here's the strategy. You max out your 401k while working, getting tax deductions, then you quit your job or take a year with low income. You convert chunks of that 401k to a Roth IRA, paying taxes when your rate is super low. Wait 5 years and you can withdraw those converted amounts penalty-free, even if you're only 40 years old. The gains grow tax-free forever. People retire in their 40s using this strategy, living off Roth conversions and paying minimal taxes because they're controlling exactly when and how much income they recognize. Puerto Rico is another strategy that sounds crazy but is completely real. There's a law called Act 60. Move to Puerto Rico, establish legitimate residency, and your capital gains tax rate drops to zero. Not low, zero. Plus, your business income is taxed at just 4%. You're still a U.S. citizen. You're still protected by U.S. laws. You just pay a fraction of the taxes. The catch is you have to actually live there at least 183 days per year. You can't just pretend. The IRS checks. But if you're a digital business owner, investor, or crypto trader with significant gains, moving to Puerto Rico can save millions in taxes every year, legally. Now let's talk about something controversial. Is this fair? Person A works a 9 to 5, earns $100,000, pays $25,000 in taxes. Person B owns assets, has $10 million in wealth growth, pays zero taxes. Same country, same laws, wildly different outcomes. People debate whether that's a feature of the system or a bug. Some argue it's justified. The business owner took risks. They created jobs. They invested capital when they could have just spent it. The tax incentives reward behavior that grows the economy.
There are incentives without which people wouldn't start businesses or make investments. The whole economy benefits. Others argue it's fundamentally broken. If you make money from money, you pay less than if you make money from work. That means the system is rigged to keep wealth concentrated at the top. Teachers and nurses carry the tax burden, while billionaires borrow against assets and pay nothing. That's not a loophole, that's a policy choice. Both perspectives have merit, but here's what's undeniable. The rules exist. They're legal, they're not secret, they're written in public tax code that anyone can read. The difference is just knowledge and access. Most people don't know these strategies exist, and even if they did, they don't have assets to leverage them. So what do you do with this information? First, understand the game. If you're a W-2 employee only, you're playing at maximum difficulty. You're taxed first and you live on what's left. That's not wrong, but it's limiting. If you want to build serious wealth, you need to think like an owner, not an employee. Second, start small. You don't need millions to benefit from these principles. Buy one rental property, start a side business, open a self-employed retirement account. These moves start shifting you from the employee tax system to the owner tax system. The strategies scale with your wealth. Third, get educated. Read the tax code, or more realistically, read books by CPAs and tax attorneys who translate it. Listen to podcasts, take courses. The information isn't hidden, it's just not taught in school, because school prepares you to be an employee, not an owner. You have to seek this knowledge intentionally. Fourth, hire professionals. A good CPA who understands tax strategy is worth their weight in gold. They don't just file your taxes, they plan your taxes. They structure your business, your investments, your life to minimize what you pay legally. That expertise pays for itself many times over. Let me give you a reality check, though. These strategies require capital. You can't do a 1031 exchange if you don't own property. You can't borrow against assets if you don't have assets. You can't benefit from business deductions if you don't have a business. The system rewards people who already have resources. That's the uncomfortable truth. But here's the thing, everyone starts somewhere. Warren Buffett bought his first stock at age 11 with $114.75 he'd saved. His first rental property he bought as a young man. He didn't start rich, he started with knowledge and consistency. The strategies that work for billionaires today worked on his first $1,000. The psychological shift matters more than the money. Employee mindset, trade time for money, pay taxes, spend what's left. Owner mindset, acquire assets, create income streams, leverage tax code, reinvest. That shift can happen before you make a single dollar differently. The mindset creates the actions create the results. Let's address one more objection. Is this morally okay? You're following the law. You're not hiding money. You're not lying. You're just using rules that exist. If the government didn't want people doing this, they'd change the law. They haven't. In fact, they keep creating new incentives, opportunity zones in 2017, bonus depreciation increases, qualified small business stock exclusions. The code is literally designed to encourage certain behaviors, starting businesses, investing in real estate, funding energy production, developing low-income areas. The tax breaks aren't accidents, they're policy tools. Using them isn't gaming the system, it's responding to incentives exactly designed. That said, there's a difference between tax avoidance and tax evasion.
Avoidance is legal, using strategies within the law to pay less. Evasion is illegal, hiding income, lying on returns, creating fake deductions. Everything I've described is avoidance. Stay on that side of the line. The penalties for crossing it are severe. Some real numbers to drive this home. ProPublica analyzed IRS data and found that the 25 richest Americans paid an average true tax rate of just 3.4% between 2014 and 2018. Not because they cheated, because their wealth grew through assets while they took minimal salary. They borrowed to live. They donated to charity. They used every legal strategy available. Meanwhile, a single person making $80,000 pays an effective rate around 18% after deductions. That's 5 times higher than billionaires. Same country, same time period. The difference was structure, assets, knowledge. The billionaires aren't smarter, they just play a different game with different rules. Here's a specific example. Elon Musk takes no salary from Tesla, zero. He has stock options instead. Stock options aren't taxed until you exercise them, so his income, according to the IRS, is basically nothing in most years. But he's worth hundreds of billions of dollars. He borrows against his stock to fund his life. No income, no taxes. Totally legal. When he does exercise options, he pays taxes, and they're massive. In 2021, he paid $11 billion in taxes, the largest individual tax payment in history. But context matters. He paid that because he exercised $28 billion in options. His actual net worth is over $200 billion. So he paid taxes on 14% of his wealth, while the other 86% grew tax-free. Let's bring this back to normal people. You're not going to replicate billionaire strategies tomorrow, but the principles scale down. My neighbor is a teacher. She bought a duplex 3 years ago, lives in one unit, rents the other. The rental income covers most of her mortgage. She deducts depreciation, interest, expenses. Her taxable income dropped. Her wealth increased. She's building equity while reducing taxes. Another friend is a software engineer. He started freelancing on the side, just 10 hours a week. That made him self-employed. He bought a laptop through his business, deducted his home office, wrote off software subscriptions, started a SEP IRA, and contributed $15,000, all tax-deductible. Same job, same income level, way lower taxes because he shifted to owner mentality. The point is, you don't need millions to start benefiting. You need to understand that employment income and asset income are taxed completely differently. Then you need to start shifting your income sources from the first category to the second, little by little. Let's talk about one more advanced strategy, the backdoor Roth IRA. If you make too much money, you can't contribute directly to a Roth IRA, but there's no income limit on conversions, so you contribute to a traditional IRA, non-deductible, then immediately convert it to a Roth. Now you've got money growing tax-free forever. Or the mega backdoor Roth. If your employer's 401k plan allows it, you can contribute after-tax money beyond the normal limit, up to $66,000 in total in 2024. That's $66,000 a year going into a tax-free account. Do that for 10 years, let it grow for 20, and you're talking millions that will never be taxed. Here's the pattern you should notice. Every strategy involves either deferring taxes, converting taxable income to non-taxable forms, or leveraging deductions. That's it. Those are the 3 mechanisms. Everything else is just creative application of those principles in different situations. The tax code is 70,000 pages long, but you don't need to know all of it. You need to know the 50 pages that apply to your situation. If you own rental property, learn real estate tax law. If you own a business, learn business deductions. If you invest, learn capital gains strategies. Focus on what's relevant to you. Let's address the biggest objection. This sounds complicated. It is at first. So is driving a car. So is cooking a good meal. So is anything worth knowing. The difference is we teach everyone to drive because it's useful. We should teach everyone basic tax strategy for the same reason. It's one of the highest returns of your time. Spend 20 hours learning tax strategy and it could save you $10,000 a year for the next 30 years. That's $300,000 for 20 hours of learning. Show me another skill with that return on investment. You can't. Financial literacy, specifically tax literacy, is the highest leverage knowledge most people never acquire. So where do you start? 3 concrete steps. 1. Read Tax-Free Wealth by Tom Wheelwright. It's the clearest explanation of tax strategy for normal people I've found. 2. Listen to podcasts like Bigger Pockets or Radical Finance. They break down strategies in plain English. 3. Schedule a consultation with a proactive CPA, not someone who just files returns, someone who plans. What should you ask that CPA? Based on my situation, what am I leaving on the table? Most people overpay taxes by thousands simply because they don't know what deductions exist. A good CPA finds those opportunities. They pay for themselves in the first year, then keep saving you money forever. Here's what happens next. You start learning. You realize the game has been happening around you this whole time. You start making small moves, buying assets, structuring income differently, maximizing deductions. Your effective tax rate drops from 22% to 15%, then to 10%. Your wealth starts compounding faster because you're keeping more. 10 years pass. You look back. Your friends who stayed pure W-2 employees are still trading time for money and paying 25% in taxes. You've built a portfolio of assets, throwing off income, paying minimal taxes through legal strategies, and compounding wealth exponentially faster. Same starting point, different trajectory. The difference was knowledge. This isn't about becoming a tax cheat or feeling guilty for following the law. This is about understanding reality. The tax system has 2 tracks, one for people who work for money, one for people whose money works for them. You're allowed to switch tracks. Most people just don't know the track exists. Remember Person A and Person B from the beginning? Both made $1 million. Person A paid $370,000 in taxes because they got $1 million salary. Person B paid 0 because they borrowed $1 million against appreciated assets.
That's not unfair. That's just how the system works. You can be angry about it, or you can learn to use it. The people who design this system aren't smarter than you. They just had different incentives and knowledge. Now you have the knowledge too. What you do with it determines everything. You can stay on the employee track, and that's fine. Many people live good lives there. Or you can start shifting to the owner track and play the game differently. Final thought. This isn't get rich quick. This is get rich legally over time. These strategies compound. A 10% tax savings on $50,000 is $5,000 a year. Invested over 30 years at 8% returns, that's $612,000. That's the difference between a comfortable retirement and a struggling one. Not from earning more, just from keeping more. The tax code is the single biggest financial impact on your life, bigger than your salary, bigger than your investment returns, because it touches everything. A 25% tax rate means you need to earn $133,000 to have $100,000. A 10% rate means you only need to earn $111,000 for that same $100,000. Same lifestyle, $22,000 less required every single year. So, here's your action step. Don't just watch this video and forget it. Pick one strategy, just one. Research it. Figure out if it applies to you. Take one step toward implementation. Maybe that's talking to a CPA. Maybe it's buying a tax strategy book. Maybe it's starting a side business. One step, then another, then another. Because here's the truth. This information won't change your life. Action on this information will. The gap between knowing and doing is where most people get stuck. They learn about real estate tax benefits but never buy property. They learn about business deductions but never start a business. Knowledge without action is just entertainment. The system isn't changing anytime soon. Both political parties use these same strategies for their donors and themselves. These aren't partisan loopholes. These are features of the code that both sides agree on because both sides benefit from them, which means you can count on these rules being available for decades to come. Person A and Person B, same $1 million, $370,000 difference in taxes. Same laws, different knowledge. That could be you, not someday, not when you're rich, right now, with your next decision. The question is, which person do you want to be? The one who pays because they don't know better, or the one who keeps it because they played by different rules? That's the choice. And now you know the choice exists. What happens next is up to you. Welcome to the game.